Benjamin Graham opens Chapter 3 by reminding us that a stock portfolio is only a small slice of the enormous machine called the stock market, and that anyone who wants to invest with prudence should have a feel for market history, namely its great ups and downs and how prices, earnings, and dividends relate over time. He leans on a century of data stretching back to 1871 to show that markets move in long waves and in short, sharp cycles. If you look at the long picture Graham paints, you see three clear stretches. From 1900 to 1924, the market moved in relatively short cycles, averaging only a few percent a year. Then came the roaring New Era and the terrible crash of 1929, followed by a sluggish period through the 1930s and war years that left prices barely higher by 1949 than they had been in 1924. After 1949, though, came the great post-war bull run. A rise so strong that between mid-1949 and early 1966, the Dow climbed from about 162 to 995. More than a six-fold increase in 17 years, roughly an 11% annualized increase before dividends. Those are large numbers, and they shaped everyone's thinking about what stocks could do. But Graham's key point is a skeptical one. Big past gains do not guarantee big future gains. He worries about two traps. First, people tend to extrapolate recent history into the future and assume last decade's return will continue forever. Second, as a market rises, valuation measures like the P-ratio get stretched. Graham shows how P-ratios moved wildly after World War II. Dividend yields shrank, bond yields rose, and stocks began to look dearer by traditional standards. In plain language, higher prices today mean lower expected returns tomorrow, other things equal. Graham emphasizes the difference between long-term averages and short-term experience. Yes, stocks have rewarded patient owners over many decades, but the investor is made or broken by what happens over years and even months, the intermediate swings. The 1961-62 swoon, or the devastating collapses back in 1929, are reminders that recoveries can take a long time. If you bought at a peak and needed your money in a few years, the long-term historical average is cold comfort. He also urges looking at earnings and dividends, not just prices. The 10-year and decade averages smooth out the noise and show that growth in earnings, dividends, and prices is uneven from decade to decade. In the late 1960s, Graham notes a deterioration in overall earnings and a rise in corporate fragility. More companies reporting losses, more financial stress, which made valuations look less defensible. When it comes to practical judgment about market levels, Graham applies all this data to ask whether the market in early 1972, the S&P at around 100, the Dow near 900, was a sensible place for conservative buying. His conclusion is cautious. On some metrics, the market didn't look crazily high, but when you compare stock yields to bond yields, the picture becomes less favorable. Put simply, stocks at those prices offered less return for the risk than they had in earlier decades. That led him to advise caution: avoid borrowing to buy stocks, avoid increasing your stock allocation, and consider trimming equity exposure to keep stocks at or below about half your portfolio if you're a conservative investor. The modern commentary picks up Graham's timeless warning and presses it forward. The biggest mistake is to assume the future will mirror the recent past. Prominent bulls have repeatedly promised that stocks will always win, only to be proven wrong when markets reverse. Valuation matters. Robert Shiller's later work, for example, uses long-term, 10-year average earnings to show that extreme valuations tend to presage poor long-run returns, a technical echo of Graham's common-sense skepticism. So what's the takeaway? Graham says, learn history, but don't worship it. Recognize that markets swing wildly, value what you buy, and above all, be humble about forecasting. If you're unsure, choose caution. Don't lever up, don't overcommit to equities, and respect the possibility of serious drawdowns. Over the long haul, stocks can reward you, but only if you pay attention to price, valuation, and the human tendency to get carried away.